Give us 30 minutes each week to discover the trends that are shaping the future of retirement with That Annuity Show. We bring you conversations with industry leaders who are revolutionizing financial products, technology, and distribution channels. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And I can't believe we're to the end of yet another quarter, and our returning guest, Mr. David Czerniecki, the Chief Investment Officer of Nassau Financial Group, joins us to give us his insights into the markets and how they may or may not impact our annuity business. So, David, welcome.
Thanks, Paul. Good to be here.
Yeah,
Go ahead. It's an interesting quarter in that if we just looked at the start date and the end date, you wouldn't think anything happened.
No, you wouldn't. In fact, I sent you notes over, and it was almost a refresh of what we said last year. But I'll try to do it, or last quarter. Well, I'll try to bucket them a little differently because things change, but they don't change. Let's try bucketing tariffs and inflation. You know, it's hard to not turn the television on and hear about the two interchangeably. Some people insisting tariffs aren't going to drive inflation, or they won't, and others saying, well, where is the inflation? We think it's coming, but we're not too sure. You know, what do the numbers actually look like?
So it's interesting, Paul. I think most economists will tell you that tariffs in and of themselves are not inflationary, because what inflation is, by definition, is a sustained rise in prices. So what tariffs are a shock. In other words, to use the oil equivalent, if your gas goes from $3 a gallon to $3.50 and stays there, technically, that's not sustained inflation. You're now paying $3.50 a gallon. If it goes up again next year by another 50 cents, and then next year, that's where you have real problems, because people will start to behave differently and start to react differently in terms of spending, in terms of wage demands, and so on and so forth. All right, so I've digressed a little bit here. So tariffs. There are a couple factors. One is what I just said, is it inflation or not? I think the general consensus, though, is in the short run, it would be inflationary. But the truth of the matter is not a lot has actually kicked in, flowed through, and kind of hit Main Street yet. And that's because we've had some delays, we've had some renegotiation, we've got some more stuff going on in that regard. So in the market, I think initially when Liberation Day came, reacted pretty violently to the news. But then as we've gone now a couple of months and things haven't really been implemented, I guess it's 3 months really, or at least 2.5. I think people are starting to take a wait and see approach. Well, now there's a new noise on, steel and aluminum, but will it go into effect? Won't it go into effect? Will it stay? So I think people are kind of taking a wait and see approach. Having said all that, there are still some inflationary pressures out there. You've seen the Fed, continue to hold firm, and the expectations of rate cuts continue to be modest, if not zero. And that's in part because of the volatility. So you've got two kind of things pulling at it. On the one hand, you have the potential, the potential that is still there for price pressure, whether it's from reductions in the employment base for lack of interest in jobs, AI, whatever things that could cut the employment base, including deportations and more restricted immigration. But on the other hand, you've got concerns about the economy, where it's going. Recessions tend to be disinflationary. Of course, we do worry about stagflation, but recessions tend to be disinflationary. So you've got these two things pulling at each other, and the Fed is very much taking a wait-and-see approach from a short-term rate perspective, for sure. So, I think it's kind of watch this space a little bit.
Yeah, I think one good sign, was jobs looked healthy,
Yep.
but we didn't see wage inflation.
That's right.
A week
That's
or two ago, right?
The job market is definitely definitely softened a bit, and it's not so much the numbers; it's the job openings are shrinking. So there are signs that the job market is softening a bit, but obviously we haven't seen unemployment tick up in any material way. And from an economic perspective, it's kind of what we really want, right? You don't want to see people unemployed, but you don't want to see so much demand for employment that you're running high inflation like we were a couple of years ago. So is it Goldilocks? It kind of feels like that, although it doesn't feel very good, does it?
No. Well, I feel much better looking at my 401k account now.
That's right.
Than I did a few months ago. All right. Next, topic number 2. Okay. Yeah. The one big beautiful bill, I think I may have miscalled it, and bond markets. Annuities. Oh, we live on the bonds. We live on bonds.
That's right.
How does this all play out? The bond market went nuts. I think it worried a lot of people a few weeks ago.
Yeah.
If this bill goes through and we see these deficits go up, what happens to the interest rate that we pay on our deficit? How are you looking at this, and how is this going to impact the annuity industry in any way?
Sure. So let's just kind of start with the markets and the reaction and things, and then we can talk a little bit about what it means for annuities. But much like what we were just talking about with tariffs versus inflation versus economy, you've got a little bit of that going on here. So we have the one big beautiful bill, but that, as we all know, is a House bill. Senators will behave differently. They are, not many are up for re-election soon, right? Those longer terms and stuff can have an impact. They tend to be more independent-minded than the House, relative to party, if you will. Like they're far more focused on their state and their state only kind of thing. And so, what's in it for me, so to speak. I think we're taking a bit of a wait and see approach in terms of it making any hard, irreversible decisions, if you will. Are we extending? Rates are up a bit. You're almost at 4.5 on the 10-year again. Are we extending duration? Well, a little bit, because we think this is a decent rate. But are we piling in? No, because there's a lot going on still. So, much like with the inflation thing, you've got questions around where the economy's at. And that's the market's reacting. The bond market's reacting to that, say, if we have a recession, rates will come down. They'll need to come down. The Fed will have to cut rates. You don't have growth. You don't have pressure. So let's come down. Oh, but wait a minute. If we pass all this, it is definitely going to increase the deficit. Maybe, if you listen to the Treasury Secretary, in time, it would spur enough growth to offset that, and you'd actually have government revenues rise. I think the market isn't 100% bought in on that, number one. Number two, it would take time, and I think the market's at a place here where it's just, prove it to me, show me, right? And so I think if the market would rather be wrong and be defensive than sort of guesstimate this. And if the market turns out to be wrong and we have higher growth over the next couple of years as a result of these changes, or this bill kind of goes through as is or whatever, then I think you'll see the market, look, if the economy starts roaring and receipts come in and we're paying down the deficit, I think you'll see the bond market react pretty dramatically. We think that's a bit of a long shot, Paul. And we think I don't know if we've ever talked about the so-called bond vigilantes, right? These are the disciplinarians in the market, like your old school teacher, right? Who's sort of hanging around at the edge of the playground. And if you try to get out, you're going to get whacked. So, and that's a little bit what's happening here. The Fed controls the front end of the curve. They have a little bit of influence over the intermediate longer end, only because of all the mortgage holdings that they had and built up following the financial crisis, and then in trying to create liquidity during COVID, et cetera. But the bond market itself has greater control over the long end, and the rising deficit and rising cost of financing the deficit is a very, very big deal.
Well, two questions related to annuities on this one. And I guess question number one is, if we don't tame the deficit, let's take a bad scenario.
Mm-hmm.
We don't tame the deficit. Interest rates go up for treasuries. Guess what? The long end of the curve goes up. Does that, what kind of situation does that put us in 2035, I guess, or 2036, when the Social Security Trust Fund, quote unquote, runs out of money? How big of a hurdle is that for the government to actually, how big of a hole is that for the government to fill?
It's huge. As one of my friends in this business says, he said, the numbers you really have to worry about are 3 and 7. $37 trillion. and so it would be a huge problem. In addition to sort of getting spending under control, fiscal discipline, et cetera, I think there's probably not many places you look where people don't say and do the math and show you that you also have to tackle entitlements in some way, shape, or form. You'll need some reform. I think I was telling another group recently that the challenge with that is you need entitlement. Addressing entitlements requires a bipartisan solution. Neither party is going to be the one to choose to make a change to Social Security or Medicaid or anything like that. Cut it, raise it. It doesn't matter what the change is. Neither party is going to be the one who will go off and do it alone and take one for the team and not have their party stand a chance of election for the next 20 years or something, right? So that means they have to get around the table and come up with a split the baby kind of solution here. And, what do you think the odds of that are?
Interesting. Now, if I'm an agent selling annuities,
mm-hmm.
Okay, on one hand, rising interest rates, should give me, higher price. My guaranteed income should go up.
Mm-hmm.
The threat of Social Security not taking care of people should give them more impetus to buy these contracts.
Mm-hmm.
On the other hand, David, if the rates go up too high, then, it's tougher for these insurance companies to actually put products out. How do you net this all out? Is it just the speed of which these rates change, or is it the magnitude, or is it both?
It is a bit of both, Paul. And I don't want to do the on the one hand, on the other hand thing too many times to you, but it is a bit of it is a bit of both. It is the speed and the magnitude. We're still in a very volatile environment. I know it doesn't. For people who don't live in these markets, it doesn't seem that bad. But the truth of the matter is, our rate swings are ginormous compared to what I had experienced throughout the bulk of my career, which is considerably long at this point. So we are still in a very volatile environment. But there does seem to be some measures of control around, not controls, but there does seem to be a slower moving train. And the deficit problem and the bond vigilante and the rising rate does seem to be reacting to all news. So it's not like a big stair step kind of thing. It could happen that one day the bond market wakes up and says, you know what, enough's enough. You guys are nuts and you've gone too far and we have no bid, and you're going to see rates like pop. But it generally seems to have been the case and continues to be the case that rates are jumping around a bit, but still in sort of a step function as opposed to a big gap. And so from a sales perspective, from an annuity perspective, if you're a client looking to buy a product, or you're an agent, trying to sell a product, you can look at the ticker and kind of see where rates are. You can look at the spreads that we're offering on top of that, and so on and so forth. And, you might be negatively surprised next quarter if you had waited a quarter that, rates might be, 10 or 20 basis points higher. Or you were the smart guy who bought now and the rate's 10 or 20 basis points lower, but you're not looking at a point.
Right.
Right. Or swings of that nature. Now, Paul, the other thing that, people should keep in mind is that if we are talking about an environment where the expectation is that rates will rise for whatever reason, whether it's inflation, bond vigilantes, deficit, or whatever, as opposed to rates falling because of softening or economy or recession. But if you're in the camp that things are going to be okay, and so therefore rates might go up, rising rates are not good for stocks. Recessions aren't good for stocks either, but rising rates are not necessarily good for stocks. And so it makes the argument for annuities. You couple that with the concerns around Social Security, et cetera. It makes the argument, more compelling, honestly.
Right. Well, maybe shift topics.
Yeah.
And very last one, our favorite topics, AI and energy. I mean, David, I live on AI today. I don't know if they unplug it. I'm not sure if I'm going to know how to work here. But how do you play think through all this? Now, NVIDIA got hammered a little bit, but I kind of say, we'll just wait that one out.
Mm-hmm.
Energy, on the other hand, who would have ever thought that a company that made MS-DOS would be buying or paid for nuclear power plants? It's crazy.
Right. No, and Paul, I have to give you credit because I think early on, as you and I began to talk about this topic, you did raise the question about sort of a potential significant change, energy revolution, whatever you want to call it, and what the impacts would be and what the investment opportunities would be, et cetera. Look, I think as we've discussed before, AI is here to stay. I think the speed of adoption, the speed of implementation, the impact on efficiency, the impact on productivity and stuff, all kind of remains to be seen. But all indications are that it's moving at a pretty quick pace. Right? Maybe it'll go faster. Maybe people are being overly optimistic about the speed, but it's moving pretty quickly, and the impact's pretty great. I mean, think about what you and I have been talking about this for over a year. Think about how you were using it a year ago and how you're using it now.
I know.
Right?
Oh,
so the impact's there.
Yeah.
And that means that, in some way, shape, or form, demand is there. And we all know that, one of the things that AI needs is the chips, and what the chips needs are cooling. And so the energy demand is clearly up. And expected to be up, and you're watching firms like Amazon and Microsoft and stuff trying to lock some of that in as much as they can, quite honestly. So that suggests sort of an increased demand. Now, how does it play through? Under the current administration, some of that will play through in the form of fossil fuels, and as we know, the need for fossil fuels is there and will be there for quite some time. Even without AI, it was there. And so now you've got a sort of friendly administration to that. It is still the cheap, one of the cheapest, if not the cheapest form. So that's there. We're finally seeing an acceleration, maybe, of regulatory flexibility for nuclear, so that plants could sort of come back online or be new things built. There's some technology changes that are speeding the time period and stuff, but it still takes a really, really long time to bring a nuclear power plant up and running. But you're seeing some receptivity to that, and that seems to be a little bit more broad based than just one political party.
No, well, I agree. Listen, I'm thrilled to see some of the regulation go away because I've seen studies, I'm sure you have too, David. There is a direct correlation between the amount of power you have in the country and your GDP. And I think China has been bringing new power plants to online faster than we could imagine. And I think that's, we need to say catch up, make sure we're energy exporters. Or
at least remain self-sufficient, right?
Correct.
And I think you're seeing some steps in that direction. Now, the proof again will be a bit in the pudding in terms of how quickly these things come online. And then the other factor that people aren't talking about is, what you and I from our youth would remember as the NIMBY program, where are you going to put the nuclear power plant, right? Right? I know Paul doesn't want it in Westchester, right?
Nantucket. We're going to put it on Nantucket.
Those guys are. Wind is okay there, Paul.
Yeah.
Wind is okay. No, seriously, right? So, and you still have, connectivity to the grid and stuff. There's a lot of infrastructure movements that also have to happen as part of this. If I want to make fun of the current administration, we'll go back to the quote of drill, baby, drill. That's only one step in the process.
Well, right. Right. And I don't think they're drilling because the oil prices are coming down.
No. But the point is that regardless of where the power comes from, we've got to get it to where it's needed. And so there's still a lot of work, but it is heartening to see some flexibility and some openness and response to reinstituting some nuclear power. I mean, people, I understandably worry about it. And again, we were joking. You don't necessarily want it in Westchester, but the flip side is, you look around the world. There are plenty of countries, France kind of being the flagship here, that are predominantly nuclear power.
Right. Well, listen, David, thanks so much. This was great. Appreciate your insights into the market, and you always, give me a new perspective on, the news or what I'm seeing happen in the market. So thanks so much. And I'd like to thank our listeners. Be sure to tune in again next week for another great episode of That Annuity Show. Thanks.
Nassau Financial Group is always working harder to be your carrier of choice. We build products that help protect people's savings and are dedicated to providing you with best-in-class service. We seek to keep things simple and have your back in the years to come. Nassau is headquartered in Hartford, Connecticut. Learn more at nfg.com.
Zinnia, an Eldridge Industries business, simplifies insurance. It delivers comprehensive solutions for the industry's most critical needs and creates the modern rails of the insurance industry. To learn more about Zinnia, please visit zinnia.com.